Manishi Chaudhary, Managing Director and Head of Research with BNP Paribas. He joins us live. Manishi, good morning. Thank you for joining us. Manishi, last 2 weeks have been rather volatile and choppy for Indian markets. Things have been all over the place and Indian markets are massively underperforming global markets. Why do you think that is happening and what do you think it means for the rest of the year?
I think you could summarize the reason in one word, which is fatigue. After that significant rally that the market had from around mid-September onwards, it actually resulted in significant outperformance by India till around mid-January or so. And so the market had to take a breather because some of the stocks which investors would like to buy, in private banks, industrials, autos, they had become possibly a little too expensive or, close to the upper end of their valuation ranges. Therefore, the market had to take a breather and, consequently, if these stocks are available at a slightly cheaper price, then I would think that that would constitute a better entry opportunity for investors. And I think investors are also beginning to look at Indian market in the same way. There are some concerns that, there could be a, kind of a throwback to populism in the budget or so. So I think, in the absence of any significant triggers before the budget, the market is also in an indecisive mode. So it's a combination of all these things that have led to this correction in the market. Having said that, it's not been very significant. From a level of 20,000 on the Sensex, it's possibly down to about 19,400, which is, about 3 to 4% from here.
Manishi, Tata Motors, the company, I guess, has done a great job of expectation management. First, they, gave a profit warning, and now you get dispatch numbers, which are way above estimates.
Absolutely. I think fundamentally Tata Motors is doing well. The concern is not so much in volumes. The concern is more on margins. And if you recall the so-called profit warning that they gave a couple of weeks back, that was also centered around a margin guidance. So I think, yes, volumes are doing well. One would have to watch for the kind of margins that they generate on these sales. And so for the time being, we maintain our position in Tata Motors in the model portfolio. We do have Tata Motors, even though it's slightly lower than the benchmark weight. So, while we do have a position in Tata Motors, we at the same time are slightly cautious about the medium term.
Manishi, just like the consumer stroke FMCG trade became a crowded trade for 2012, do you think for 2013 cyclical stroke the financial trade is getting a crowded one?
I think some of the private banks have moved up very sharply, particularly if you look at Axis or ICICI Bank. So obviously with some correction, they would provide a better buying opportunity. But at the same time, I would mention that the valuation comparison is nowhere close to, what the consumer staples were trading at. If you look at the frontline consumer staples like Nestle, Levers, they were trading at close to 30 to 35 times P at peak. Now, of course, some of them, particularly Levers, have corrected significantly from those levels. But in comparison to that, when you look at the price-to-book value of the banks, even the private banks, they're possibly in the range of 1.7 to about 2.1, 2.2 times. Leave out the HDFC pack. That has always been expensive and will possibly remain so. But, as a consequence, we think that these private banks are still possibly close to the middle of the range, middle of the historical range that they have trading at, maybe slightly higher than the exact middle point. But, but we can't really classify them as, significantly overvalued as we could for the consumer staples pack. So I think, yes, for a long-term investor's perspective, possibly may not be very attractive to enter at these levels, but if these private banks do correct, and, in my reply to your previous question, I was alluding to the fact that the market may correct some more, which will possibly drag down the high beta stocks a little more, then I think it would provide a renewed buying opportunity into these private sector banks.
Manishi, going by the same logic, how would you approach some of the real estate names? I mean, names like Unitech and DB Realty aside, would you use the kind of damage that we've seen in other names like an HTIL, Prestige, JP Associates as a buying opportunity?
See, honestly, real estate pack in India, you could actually divide them into two halves. The companies where one has significant concerns about corporate disclosures, management quality, etc., and also about cash generation, and the other pack where you don't really have such major concerns. We tend to prefer clearly that second pack, and in that second pack you have stocks like Oberoi, you have stocks like Prestige or Shobha. So those are the top 2 or 3 names that come to my mind, which are not only cash generators, but also there are no significant corporate disclosure related concerns which are attached to those stocks. So that's really the group of real estate companies in India that we prefer. And one of them, like Oberoi, is also present in our model portfolio.
Manishi, based on Q3 numbers, have you changed your FY13 estimates and have you revised your FY14 numbers as well?
Okay, actually, we did some earnings estimates revisions around the second half of January, around the second or third week of January, based on the initial results and, of course, that profit warning by Tata Motors that you talked about. So, at that stage, the estimates came down slightly. Not much, just about 1 to 1.5%. So we currently have, for fiscal 13, we currently have an estimate of about 1175, which increases by close to about 15 to 16% for fiscal 14. At the same time, we think that for fiscal 14, the numbers may come down slightly, maybe just about 1 to 2%. On the back of some earnings downgrade in the public sector banks and possibly in metals. Metals, materials, commodities. That pack is not really doing well. At the same time, there could be some upgrades as well. And these upgrades would possibly concentrate around IT services and some of the private sector banks. So net-net, we think that this 14 to 15% earnings growth in fiscal 14 may actually be realizable. We also think that the phase of downgrades, earnings downgrades in India, is possibly on the last leg. We have pretty much reached the trough of the earnings estimates, and maybe from the second half of the year, second half of calendar 2013, that is, we could see earnings estimates gradually moving up. That is another factor that gives us some degree of confidence about the longer-term future of the Indian market.
Manishi, but high commodity prices and stubborn inflation, do you think that will force you to revisit your estimates? Because when we started the year, the basic underlying assumption was crude will crack and commodity prices will come down. But pretty much the reverse trade has panned out so far this year.
So in case of commodity prices, there is a difference between crude and other commodities. Yes, crude has been stubbornly high. It's moved in the range of $110 to $116 on Brent. Sorry. But, other commodities, steel, aluminum, copper, after that initial uptick from late last year to around the beginning of this year, they seem to be moderating, and we think that there is still a lot of capacity that is coming up in the metals and plastic sectors all across Asia. And as a consequence, we think that commodity prices, particularly the harder commodities, metals, plastics, they would continue to moderate. When that happens, that is a clear lead indicator as far as India's core inflation is concerned. I have a chart hidden somewhere which actually tells you that commodity prices tend to lead manufactured product inflation by somewhere around 6 to 8 months. So this moderation in commodity prices, which started about 1.5 years back, we think that that would lead core inflation in India even lower than where it is. The second input to inflation is food inflation, and there we think that there's a significant high base effect that's opening up over the next 3 to 4 months. So by the time you're in March, April, you could see food inflation decline significantly. I think these are the two factors, the two important inputs that the Reserve Bank of India had at the back of its mind when they decided to cut not just the repo rate, but also CRR in the last monetary policy. And so we think that in 2013, it could actually turn out to be a relatively benign year for India as far as monetary policy is concerned. And importantly, India would possibly be the only country in the Asian Pac which would have a relatively benign monetary policy.